Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets because you can't control when a storm hits, but you can control how you navigate out of that storm. I'm Jake Ackerman. This week in the markets, we see it rising. We see energy prices rise, and we see interest rates go sideways. So let's take a look under the hood and try to decipher what's going on here. Last week, we had the Fed meeting. The FOMC committee announced that they were going to be hiking rates by 25 basis points or 0.25%. And they said essentially they're going to pause after that and wait and see what takes place. And the reason for the pause, they were anticipating having to continue raising rates one to two more potential times. But the banking issues with the SVB Bank, Signature Bank, and then the First Republic that was kind of teetering on the edge there has really thrown a wrench in their plan, where they're going to say that, hey, we're going to take a step back. We're going to see how our rate-raising campaign, our tighter monetary policy. And when I say tighter monetary policy, I'm just saying that, hey, if you are a business, you go to the bank and you're trying to get a loan, your lending standards are harder. Interest rates are higher, so obtaining credit is challenging. So that's what I say. The credit markets are tighter, and we're seeing the lending standards and the tighter monetary policy lending standards remaining tight, and they're continuing to rise, despite the Fed saying, "Hey, we're not going to hike interest rates anymore." And that's kind of a domino effect, you could say, from the banking issue. Banks are worried. Their lending standards have gotten harder, more difficult. So the Fed doesn't really need to hike rates because the banks are going to do it for them. That's what they believe at this point. Now, does that come to fruition? We'll see. Their standards are definitely becoming tighter, but the Fed isn't raising interest rates at this time. And if you look at credit, the standards have already been high anyways. I mean, they're looking at higher credit scores. They're looking at higher income to debt ratios. So the standards are already fairly high to begin with when you go out to try to obtain credit. So no more hikes going forward here from the Fed is what they've said. At this point, probably, unless we get some huge major spike in inflation. So, and the markets sold off a little bit after that. Not a major sell-off, I think it was 1 to 2%. And now this week, the markets have been rising. It looks like they digested what the Fed had to say in a positive manner. And the markets look like they're going to fare well as the markets rise. Energy prices have significantly come down since last year. Yeah, they've risen a little bit this week, but there's still a major downtrend. And the interest rates have been coming down since October of last year, right at the same time the stock market bottomed. And it's been trending down, going a little bit sideways. I think the bond market, and I always tell you folks, is the bond market are the best traders in the world, are the institutions. They're the ones that we like to watch and see what they're doing. They have the insights. They know the CEOs. They're more sophisticated than your equities investor, which is equities or stocks. So what are they doing? They're going sideways right now, trying to gauge which way is the Fed going to follow through with what they said they're going to do? No more rate hikes. So the bond market's trying to gauge by going sideways, and I think we're going to get our answer on Friday of this week. And normally we do our updates on Friday, but we're going a little transition here at my office, so we're doing it a little bit early this week. So again, we'll touch base next week and talk about the data that's going to be released on Friday. And what data, you ask? It's PCE data, personal consumer expenditures, inflation data. The inflation point that the Fed Chief Jerome Powell talks about each and every Fed meeting. It says PCE data. He highlights it all the time, talks about it. PCE is way too high, he says. So I think this is a pretty binary event that's going to take place on Friday here. Does PCE data come in as expected or below expectations, meaning below expectations means inflation's coming down, which is going to be positives for the market. Positive. Probably positive for bonds, stocks, asset prices. Real estate's still in kind of a different paradigm. That one's acting not like the stock and bond market are doing, so that's a little bit different, but those will fare well. Does PCE come in higher than expected? I think you can safely assume what's going to happen, that the market's going to have to reevaluate, say, hey, is the Fed going to have to step back in and fight inflation? Is this getting out of hand again? Do we have more worry for the banks? It's going to cause another couple weeks of worry, most likely, until the next data print, next inflation report, which will be CPI in April, and we'll be talking about that. So tune in next week. We'll discuss the results of the PCE data and where the market's going for the next couple weeks. Thanks for tuning in. I'm Jake Ackerman. Expertise you deserve, experience you can count on.